All right, let's get right into it. We're about to pull back the curtain on a secret that, frankly, separates the traders who make it from those who don't. It's a concept that once you see it on a chart, well, you can't ever unsee it.
So what if I told you that on every single chart, doesn't matter the market, doesn't matter the time frame, there's an invisible line. And above that line, everything is expensive, what we call premium. And below it, everything is cheap or discount. The thing is, most traders have absolutely no clue this line even exists. But today, we're going to make it visible.
And this right here, this is the whole game in a nutshell. When most traders see a big, powerful price move smashing through a level, their brain just screams, "Go, buy, you're gonna miss it." But the pro, they see that exact same move and think something completely different. They think, okay, the blueprint is set, now I wait. It's a total shift from reacting emotionally to acting strategically. So, let's break down that mistake because it's probably the most common and costly one in all of trading. We'll call it the breakout trap.
You see, here's the core misunderstanding. The biggest mistake you can make isn't just chasing the breakout. It's believing the breakout is the actual trade signal. It's not. It's just a clue, a hint about something much, much more important that's about to happen.
So let's start calling it what it really is. When price breaks a major higher low with real force, that's what we call a structure shift. And this is so critical. It is not a signal to jump into the market. It is the market literally handing you a blueprint. It's not telling you trade now, it's telling you where to look for your trade next.
Okay, so let's dig into that blueprint. This is the exact framework that institutional traders, the smart money, use to operate every single day. This is how they see the market.
This really just flips everything you've probably learned on its head. The retail trader's logic is to buy things that look strong and sell things that look weak. You're just chasing momentum. But institutions, they do the exact opposite. They are value investors at heart. They buy when things are cheap, at a discount, and they sell when things are expensive, at a premium. It's as simple as that. So how do they actually define cheap and expensive? It's not just a feeling. After any significant price move, they break that range down using 3 critical levels: 25%, 50%, and 75%. These levels define their zones of value.
Let's make this super clear. That top quarter of the range, from 75 to 100%, that's premium territory. It's expensive. Sellers have a huge advantage up there. The bottom quarter, from 0 to 25%, is discount land. That's where things are cheap and buyers have the edge. And that 50% line right in the middle, think of it as fair value. It's the battleground where buyers and sellers are on equal footing, fighting for control.
And here's the best part. You can make these invisible lines totally visible with just a couple of clicks. On pretty much any charting platform, you can grab a tool called the Gann box. All you do is, after a big move up, a bullish shift, you draw it from the very bottom of the move to the very top. After a big move down, you draw it from the top to the bottom. And boom, the 25, 50, and 75% levels just pop up on your chart automatically.
Okay, so we know how to spot a structure shift, and we know how to map our premium and discount zones. Now, we're going to add one more layer to this that really takes it to the next level. This is where the magic happens.
This quote says it all. You know, most traders see a support level and think, okay, I should buy here, but they don't think about the context. A support level way up in that expensive premium territory, it's weak. Why would institutions want to buy something that's already overpriced? But that same support level down in cheap discount territory, now you're talking. That's exactly where they're looking to load up. Location is everything. So what we're looking for is something called confluence. It's just a fancy word for overlap. Here's how you do it. After a structure shift, you map your premium and discount lines. Then you mark your regular everyday support and resistance levels. And the high probability zone? It's where those two things intersect. When a discount line lines up perfectly with a support level, or a premium line lines up with resistance, that's your spot. That's where you patiently wait for the market to give you a clear sign of rejection, like a big pin bar, before you do anything.
Okay, let's put this all together into a super simple, repeatable system you can start looking for right now.
It really just comes down to these 4 simple, non-negotiable steps. Number 1, and this is the hardest part, you wait for a clear structure shift. No shift, no trade. 2, you immediately map your premium and discount levels. 3, you find where those levels have confluence, that overlap, with a known support or resistance zone. And finally, number 4, you wait for price to hit that zone and give you a clear rejection signal before you even think about hitting the button.
Let's look at a perfect example on the Dow Jones. The setup started with that big bullish structure shift.
Then we see the confluence, the 25% discount line lined up perfectly with an old resistance area that was now acting as new support. And what was the entry signal? A beautiful, strong, bullish engulfing candle right at that sweet spot. From there, the targets were simple, the 50% fair value line and then the 75% premium line, a textbook case of waiting for the discount.
And of course, it works just as well for selling. Here's a trade on gold, showing the exact same logic, just in reverse. We got a big bearish structure shift. The confluence point was the 75% premium line, meaning a clear resistance zone. The signal was a nice rejection wick as price poked into that zone. And the targets, down to fair value, and then the discount level. Same logic, different direction.
Now, once you really get the hang of this core system, there are a few advanced techniques that can give you an even bigger edge. Think of this as the masterclass. So while your main hunting grounds are the 25 and 75% zones, don't totally ignore that 50% fair value line. Some really strong trades can happen right there. Also, pay attention to the absolute extremes, the 0% and 100% levels. They can act like powerful magnets for price reversals. But the most powerful confirmation signal of them all is something called a liquidity sweep.
So what's a liquidity sweep? It's when you see price dip just below a little support level inside your discount zone. What's it doing? It's triggering all the stop losses from the amateurs who are trying to sell the breakout. And then it reverses with incredible speed. The banks basically just grabbed a bunch of cheap inventory and are now ready to send price flying. When you see this happen at your confluence zone, it's like adding rocket fuel to your trade.
So let's just lock this in. The whole lesson, everything we've talked about, boils down to this one powerful idea. You buy discount and you sell premium. You stop chasing and you start waiting for value. Honestly, it is the closest thing to a trading cheat code that you will ever find. And that really just leaves us with one final, very important question to ask yourself the next time you're looking at a chart. Are you trading with institutional logic, or are you still reacting with retail emotion? The choice, as always, is yours.